get to my next guest because he's still bullish on equities, at least it seems that way, in the second half of the year, despite the sell-off. Tom Lee is the chief U.S. equity strategist at JPMorgan, joining us now. And Tom, the reason why we say that is that you've got this year-end price target of 1,300 for the S&P. Then you've got this sell-off today, and that just makes it tougher to get to that target. What do you think?
Well, that's right, Betty. It is harder to get to 1,300 if we're lower. But
right, if you do the math, yes.
Right.
What I mean by that, though, is does this change your view?
Well, we've been struggling a lot with the idea of what the 10-year is telling us because, at 2.7%, it just sends an awful signal in some ways, right? Because I think the sort of the consensus view right now is a 10-year at 2.7 is deflationary. But in some ways, I think the Fed's really trying to get the 10-year down to 2.5. I think this is actually part of their policy because,
why?
Well, when you break below 3%, you have about $1.5 trillion of mortgages that can profitably refinance, which is about 15% of the mortgage market. If you get down to 2.5% on the 10-year, it's probably going to approach $2 trillion, and you may see the 30-year fixed rate maybe even approaching 4%. So, I think we're talking about the potential for a huge refinancing boom in mortgages coming. And, obviously corporates, look at high grade. High grade now is at 4.4 yesterday.
Right.
If we go to 2.5%, high grade bonds are going to be yielding 4.2. You're going to see every company in the S&P 500 lock in 4% rates for 10 years. This is going to be a huge refi boom.
But Tom, it's John Erlichman. I've got to go back to what Betty said off the top. The S&P would have to rally 18% from where it is now by the end of the year to get to your current target of 1,300. Are you going to change that target?
Not yet. I think if the economy isn't in a growth scare, in other words, this isn't an air pocket, but this is a meaningful change in trajectory, we would have to change our target. At a 2%, 2.5% GDP growth, the S&P 500 companies will earn around $90 next year. Then the challenge is really figuring out the right multiple to put on that risky asset. And right now, 14.5, actually, believe it or not, you're going to have a 14.5 PE more than 65% of the time when the 10-year's at 2.7. Mm-hmm. It approaches 90% of the time when you get to 3.3. So clearly, PEs are the real risk right now.
Yeah, but that's exactly what I wanted to talk about because, earlier we had our CME trader on, Brian Battle, who was saying, look, the bond markets have priced everything right. It's the stock markets that are wrong. The multiples are too high.
I did a lunch with Terry Belton, who's our co-head of fixed income strategy yesterday, and one of the questions that we were posing to him, because it was an equity lunch, was, look, at a 2.7%, is the 10-year discounting 0% GDP growth? And he says that when you look at the 2.7, it's doing what the Fed wants, which is that it's forcing investors, when you get to a 0% policy rate, it's forcing them to seek duration or to seek risk. So that, the move down in the 10-year is what the Fed wants to see. And actually, the way to really think about inflation expectations is to look at the TIPS market. And when you look at 5-year TIPS, inflation expectations are very well anchored over 2%. So in some ways, what's really ironic is that at 2.7, even though equities are initially taken as a signal of almost no growth or a zero inflation, it's actually more of a signal of low monetary rates and investors forced to seek either duration or price. And in fact, the fact that we might be in front of a big refi wave of mortgages is actually pushing down Treasury rates because it's shortening duration of mortgages. So what happens is these trading models are forcing investors to buy the 2-year, 5-year, and increasing the 10-year notes. So we're actually seeing rates go down in anticipation of a refi boom as well.
Okay,
it's a technical factor.
All right, Tom, that's all very interesting, and I think another angle that we haven't covered yet so far on this. But good to talk with you, Tom. Great to have you with us. Tom Lee, the chief U.S. equity strategist at JPMorgan, and saying that he's not going to change his target at this point. Well,